Good morning, everybody. Thanks very much for joining us here at the International Investors Lounge. It's an event that we run here at EXPO Real, and we've got a full program across all 3 days, so do please join us for those. The focus now is going to be on Germany. We've got a super panel. For those who don't know me, my name is Richard Betts. We run Real Asset Media, we publish Impact, we publish Real Asset Insight, and we also publish the EXPO Real Daily News. And we run around 90 of these kinds of events, both in Europe, but also in Asia and the US occasionally, really bringing together, I guess, the investment topics and looking at the opportunities, challenges in the market, where we are and where the opportunities are to invest. Let's start with introductions. Christian, let's start with you.
Thank you, Richard. My name is Christian Scheuerl. I'm from Neworld Investment Managers. We are active in the field of managed living products and healthcare. So we have a large portfolio of operators and we help them to grow operation-wise but also asset-wise.
Super. Timo.
My name is Timo Hielscher. I am Managing Director at CTP Germany, and therefore I'm running the business operations in the northern part of Germany. For all of you who don't know CTP, CTP is an industrial real estate investor, long-term investor, operating in 10 countries, and with a gross asset value of approximately 12 billion euros. And yeah.
Great. Thomas.
My name is Thomas Landschreiber. I'm founder of Andere Wege Group and 777 Capital Partners. We are specialized in prefabricated houses made out of wood. And in 777 we are specialized in opportunistic transactions, and yeah, that's it.
Great. Felix.
My name is Felix Meithaler. I'm working for Scheuerl Capital. I'm a director for fundraising and responsible for the German institutional clients as well as family offices. Scheuerl Capital is an international platform on equity investments in the space of core to value add all over Europe as well as in Asia.
Super, thanks very much. So a good range there in terms of different perspectives which we'll pick up on during the session. And of course, if anybody's got any questions, do feel free to ask them, and we'll make sure that we deal with those. It's a nice intimate space here, so we can pick up on those points. And also, welcome to everybody who's joining this on demand live here at EXPO Real. Let's start maybe with you, Felix, in terms of just looking at international capital. You mentioned there the fundraising side. Is international capital at the moment still focused on German opportunities? How are you seeing the capital flows at the moment?
At the moment, the German market is in a phase of finding itself, that buyers and sellers are coming together. We are seeing more opportunities at the moment, and we are believing that more is coming in the beginning of next year or during the next year. In terms of international capital, of course, there's still money interested and money flowing to Germany, but we are expecting that the interest is increasing over the next 12 to 18 months.
Okay, good. And does anybody else want to pick up that point as well? I mean, Timo, there's obviously a big focus on logistics and residential at the moment. And are you still seeing capital wanting to look towards the logistics sector, and specifically here in Germany?
Yeah, I think so. Logistics markets and especially leasing markets, letting markets are still in a good stable condition, stable shape. So, of course, what we've seen in the last month is that exit cap rates were increasing, exit multiples were decreasing, and we had some turning point on the markets. Because we, as a long-term investor, we earn our money due to rental yields, and not from exit cap rates or margins coming from exits. And for us, it's quite a good time to acquire assets, because I think that prices are decreasing back to a sensible level. Because what we've seen in the last years, due to the low interest rates on financing markets, was not was a lot of speculation in the market. Let's say it so.
Okay, good. And Thomas, obviously, we've both seen a couple of cycles. I guess it would be interesting to see how you're seeing this one differently, in a way, particularly looking at Germany. And what you're seeing, are we beginning to see, for example, more value add, more opportunistic capital beginning to look at the market because they're looking at, there may be issues with refinancing and those kinds of things. How do you see that? And I guess how do you see that also running out this time in terms of how the industry and the market deals with it?
Yeah. I mean, for what we see now is that private equity money is coming to the market again. During the last 5 to 10 years, there was cheap money in the market, so there was no room for typical private equity investors. They are now coming back, have a closer look to Germany. They have pockets full of money and waiting for the right opportunities. And I think due to all the challenges we're seeing, rising interest rates, a lot of developers with the short-term financing, their financing will run out this year or next year. So they will face a lot of problems. And I think all the private equity companies are now waiting for the right opportunities.
Okay, good. And in terms of the fundraising side as well, Felix, what are you saying? Are you seeing that more of a focus on value add, opportunistic, or, and I guess what sectors are also attracting investment at the moment?
It depends, of course. It's always depending on the client and the need of the client, on their current portfolio, on their new portfolio asset allocation strategies. But at the moment, you definitely see a rise again of value add and opportunistic appetite. And we as Schroders Capital are in current dialogue with a lot of clients at the moment from Germany as well as on international clients regarding these topics. And we are doing a lot of intensive analyzing and sourcing of deals like that. So therefore we believe that operational property and operational deals, of course in the field of value add and opportunistic, but also core plus is getting more operational. We believe that the times of buying and just holding, they are gone. So every manager, either in the field of core plus and especially of course value add, have to be closer to the asset and have to work harder on the asset. So therefore I think the times are rising again for value add, of course.
And you mentioned there a bigger focus on the operational, which is interesting. We'll have sessions later around, some of the alternatives, but also senior living, healthcare, those kinds of elements, which I think are increasingly on the sort of radar here of the institutional capital, for sure.
That's always a situation when a crisis arrives, that the asset management is much more in the focus than before. And I'm totally convinced that the time is over, that you purchase a plot and then you're doing 5 mistakes and in 3 years' time you make a 25% IRR. That's definitely over. Today you have to have the asset management skills, you have to be able to construct something, you have to create value, roll up the sleeves, and you have to do something. And I think now it's the right time for the professionals in that area.
Okay, good. So the professionals coming back again. I wanted to pick up on the sectors. Christian, and I mentioned there some of the living sector, of course, residential, a big part of the market. But maybe just drill down a little bit into the types of residential, what's driving that at the moment and where you're seeing the opportunities.
I think the classical build-to-rent residential now is facing some kind of obstacles in Germany, because what the developers did in the past, as Thomas just said, with 25% IRR, developing new apartments every year more and more, doesn't happen right now at that scale. So I think the money that is interested in getting higher returns is looking into alternative ways of residential. We've been investing in managed living since quite a while, and while doing so we realized that you can also create good returns for the investors, but, and that is I think much more important, you have higher flexibility, and if we're looking at the German market, you are not so confined by legal regulations in terms of rent control, in terms of different different details that the local administrations look at. If you're saying you're building commercial apartments, which in the end rent out as small flats for younger people, like probably everyone has heard about service apartments and co-living, it's much easier to get a permission to do so than going to all the details for regular residential. So I think that is something that investors like.
Okay, so interestingly, what you're saying there is there's actually a regulatory difference between the two, which gives you more potential. And you're also operating in this area as well, Thomas.
I mean, I love all this, let's say, I love the resi area because it's a very defensive investment product. The problem with the usual resi stuff is that due to the regulation, you cannot increase rents. I mean, what we see now is that more or less every developer stopped his development. That means we will get a huge pressure on resi rents. The problem is that you cannot increase rents in the usual resi area. So I love all these active resi products like student homes, like micro-living, service living, co-living, micro-apartments, because the average stay there is between 6 months and 2 years. That means every 2 years you have more or less 100% new tenants, so you can always catch up to market rent. And your target group is not the typical, let's say, 85-year-old lady, which is a target group which has to be protected. So there's a manager for 6 to 12 months and he knows exactly what he has to pay and then he moves out. So it's a better target group, it's easier, and the pressure from the market, you can increase rents and always catch up. So that's the reason why I love it.
Okay, great. And Timo, it'd be interesting just to get some of the trends that we're seeing in terms of logistics, particularly for the German market. And we've all seen plainly over the last kind of 6 to 9 months a lack of transactions. So I'd be interested to know, A, we're all seeing the same lack of transactions in this market, but are there also opportunities for those people, you know, maybe who are more into the detail, Thomas, in terms of, you know, it's time for the professional investors to get back in. Are there opportunities actually out there that you are seeing?
Yes, definitely. I would totally agree that we are also focusing on value-add investments, because there you can achieve interesting yields, for sure. And we as a long-term investor, as I mentioned before, we have to live from rental yields, and we won't do it for 5% or 6% or to be honest. And yeah, of course, I think if you're acting in a market phase, in a surrounding which is quite unsecure, and it's definitely the right time for the professionals to step in. And if you know your business, if you have a good network, you will find always a niche to invest in. You will always find a nice product, and yeah, that's definitely what I can contribute to this discussion. And when it comes to trends in the logistics sector, logistics is very versatile. We're always talking about logistics, but we're also talking then about last mile logistics. We're talking about production. We're talking about simple storage spaces. We're talking about urban business parks with very, very versatile range of potential users and utilities. So yeah, and what the main important trend is in German markets is what we are seeing that the whole Europe will benefit of is the whole nearshoring thing, because in an insecure global environment, we think that important players will come back to Europe, produce in Europe, produce for Europe, making business for friends, with friends, and this is maybe, I think this is a huge trend that we will see, and that will also stabilize leasing markets. But I mentioned before, leasing markets are still in a good shape, but that shape will be improved due to this high demand coming from, for example, Asia.
Okay, good. I wanted to just pick up a little bit on the ESG sustainability side, not least because we have impact, but also because it's, you know, from something that, you know, wasn't in every conversation. It has been in every conversation for the past year, pretty much. Felix, it would be good to get a sense from you of how much of a driver for the institutional capital is also ESG, elements like social value, those kinds of things. Is that very much on their radar? I mean, I know it's on Schroeder's radar anyway, but is there a match also with the institutional capital?
Of course, ESG and sustainability is really important for the institutional clients, and it's over the past years it always increased and it got more important. Now we are at a point in the market where it's absolutely key. We see a lot of properties and portfolios which we are managing for clients or which we are analyzing for clients, which ESG is the key driver. For example, since 2018 we are we are developing a portfolio of a client with approximately 750 million IOM towards net zero. So therefore the goal is, which we established in 2018 with the insurance company, to be at 2030 net zero with this portfolio. We are managing the portfolio since the beginning of the 2000, the millennial area, and in 2018 they decided that it's absolutely key to get to net zero. So this is a great example how some clients have been first movers, but of course over the whole value chain this is getting more important. You can also see this for example in the office space. Selected office is still one of our focuses on the investment side, but we strongly believe that without a key team, key knowledge to get from brown to green, a lot of assets are going to be stranded, and therefore you need a manager and as your value driver in this field, and also in terms of what's going to be traded and what's going to the market and getting buy and sold. We believe that a lot of clients are analyzing at the moment their portfolio, their current holdings, and there will be some managers who have to sell assets because they can't get the brown to green stuff, and managers like us and other managers in the market are going to buy these assets and develop them into sustainable assets, long-term value creation for our and their clients.
Okay, good. And if anybody has any views on anything, you don't need to be polite. You can just come in, just to set a rule for that. And
can I add something on the ESG topic? I think what we are seeing right now is some kind of delay in adapting ESG or sustainability topics, because everyone is more or less focused on adapting to the new normal, and the things that were important 1.5 years ago, like really finding the perfect green lease and things like that, have moved very much down on the agenda of lots of investors, or at least for the developers, because they have to focus on so many other things right now that they are not able to have the clear view on what is relevant for ESG. And this is, from my point of view, something that is going to backfire in the near future, because when we have a new market equilibrium on the prices for the relevant asset classes that are trading, banks and investors are going to start looking again in detail whether you've done your homework on the ESG side as well. And if you realize, or if they realize that you haven't been active in the last 18 months, increasing the level of sustainability of the assets, we're going to see some kind of next crisis where you have quite a few stranded assets on the market again, where nobody is willing to buy and no bank is willing to finance.
Yeah, I mean, and we should pick up a little bit actually some of the debt side. How easy is it to get financing at the moment? When those issues with refinancing come in, what does that potentially mean? There's a lot of discussion around people, especially around the MES piece of financing, for example. So I don't know, Thomas, are you tracking some of that?
Yeah, sure. I mean, that's the biggest pressure point, I would say, because what we've seen during the last years is that there are a lot of not very well equity-heavy developers have financed plots and developments with, let's say, an average 70% senior, 25% mezzanine. And we have seen prices dropped by 30% within 1 year, which is huge. And a normal developer margin is 15 to 20%. So if your exit price drops by 30%, the equity is completely wiped out. So German senior lenders are a little bit more cautious, and they think that they are in a comfortable position. Their leverage has increased from, let's say, 60 to 80%. But the problem is more that these are really asset management assets. And when the developer, because his equity is wiped out, will hand back the keys, then there's no manager on that product. And this will give also some pressure to the senior banks. But at the moment, the mezzanine lenders are the party involved in the whole structure who are putting pressure on the structure. And I think this is exactly the opportunity now to step in. I think on the one hand, you can wait if they have to write off something, the developer loses all his money. So that's a typical approach from the private equity companies. But I think you have to be a little bit more innovative. Perhaps there are other solutions in which everyone involved comes out of the transaction quite well. So for example, the most important thing is to keep the banks and the mezzanine lenders happy. So you have to buy time. So if the senior lender wants to extend his loan and he asks for 10 million more equity, and you give him 10 million, but therefore he will extend his loan for the next 5 years, then you have to spend some money on the asset. Perhaps in the next 5 years you can increase rents by 15%, you can decrease vacancy by 10%, and we all know 25% more rent in 5 years' time, and perhaps or hopefully interest rates will go down when we get inflation done, and 100 bips less interest rate will give us 3 multiples more in exit, and 25% more rent and 3 multiples more means a lot in our business. So I think it's a time to do joint ventures, inject some money, get some part of the equity and do it together and manage the asset for the next 5 years. That would be a good solution for everyone in my eyes.
Okay, great. It'd be interesting just to pick up in terms of who the buyers and sellers are at the moment. Who's selling into the market, because part of the issue, I guess, Timo, is that there's a disconnect between valuations on the one hand and what the investors are prepared to pay. So who is selling at the moment? Where are you seeing the opportunities to buy, I guess?
Who is selling? As I mentioned before, what we see now is kind of a turning point. Now it's a time for long-term investors and not for the trader developers anymore. And I think what I see in the market, in the logistics market, in the industrial market, is that there are some or many trader developers who are struggling right now because of bad timing. And they now have to create capital due to selling their projects, even if they're not completely finished, or to sell their land. And this is what I see at the current on the selling side.
Okay, so there's an opportunity for you as an equity investor then to come in because there's less people in the market at the moment.
Exactly.
Okay, good. And Christian, I'm guessing that a lot of the product that you're talking about is also new development. So how is that being developed? Is that being financed? What's the situation with that? And I guess, are there challenges around that at the moment because of the market?
On the finance side, we are quite happy. It's not so difficult to attract senior financing for a plain vanilla student housing or service apartment project. While you have to factor in the higher interest rates for your construction period, that is going to eat on the overall P&L of the project, of course. The main problem is, not problem, but the challenge that you, with the increased interest rates, the prices have gone down. I think we don't need to state the obvious, but that means that lots of calculations of the developers just don't work anymore. And most of the products have been started 2 to 3 years ago under completely different conditions. So the developers right now are struggling because, at least in their underwriting, the project doesn't make sense anymore. So we see lots of developments being put on hold. And as one of the initial questions was, is there transactions in the market? Who is selling? I think right now selling is, people are, investors are selling only if they really have to, because coming from a higher level of prices, selling right now means in 80% of the cases realizing a loss, at least in your books, and that is something that most investors don't want to do, because that means that you have to show to your investors, to the people who really have the money, oh sorry, we may have made some wrong decisions in the past, and that is something that many people just like to avoid.
Perhaps one word regarding financing. I think I fully agree. If you have the right product, senior financing is still available. Yes, on the lower level, it's getting more complicated. It takes a little bit more longer, but the typical leverage, 60%, is still possible. The bigger problem is mezzanine financing, because all the mezzanine funds, they have deployed their money and it doesn't come back. So it's very dry market if you try to get some mezzanine loans. So this is, in my eyes, again, the chance for equity investors. So if you have equity, it's a good opportunity to go into the market.
Okay, great. I'm conscious of finishing in 3 minutes' time so that everybody can make it to their next sessions. So maybe just very quickly, in terms of, I guess, where you see the opportunities at the moment, and we've heard some of those, interestingly, but maybe just a sort of summary of the opportunities that you're seeing at the moment. And also whether there's anything in terms of locations that we need to be thinking about specifically in the German market, where there are opportunities maybe there more than others. Felix, you can translate that into whatever you would like, because you're less focused on that area, and I will come to you last. So let's maybe start this way. So let's start with you, Christian. Where are the opportunities, and any particular locations that we might not know about that we should?
Well, since we haven't seen transaction volume in the last 12 months on a significant level, we know that the investors that have a steady inflow of capital, like insurances, pensions, and so, they're sitting on money, waiting for the time to invest. So if you have a product in place that is providing a stable return and mitigating all the risks in the market, and maybe you're even able to tell a good story, including ESG, megatrends, and things like that, you're going to have money flowing into your products, into your investments. That's for sure in the next 8 to 12 months, I'd say.
Okay, great. And Timo, my guess would be that it would be logistics. So let's drill down a little bit into that in terms of, whether that's big box, whether that's more urban. What's your sense of where the opportunities are?
Yes. What I really like is our urban business parks. Urban business parks with small sizes, small units. For example, we can combine clean production with last mile logistics. Very, very versatile when it comes to different to potential tenants. This way, I really like this product. What I am looking for is also brownfields. I really like brownfields, and this is something that Thomas mentioned. If you have the skills to handle those really, really tricky assets, these really tricky plots, that are fantastic opportunities for us to invest in, to do soil, to clean up the sites, to create something new on the sites. This is also something that is very, very supported by the communities, and I really like it. And this is where we see our opportunities here in Germany. Not so much big box logistics, to be honest. We focus on that more in the eastern part of Europe, and but for us in Germany, urban business parks, last mile logistics, smaller logistic units, flexible parks, park maker concept. This is our concept, and this is what we are focusing on in Germany.
Great, Thomas.
I see in general the opportunity to help developers and landlords when they come under pressure, inject some equity, do an active asset management, working together on the asset, creating value, and then waiting for the right time to exit. In terms of location, normally I'm also doing transactions in B cities or C cities. The problem at the moment is a little bit due to the high construction costs. When you're in areas where you have €10 rent, there's only a limited possibility to work on the asset because you have to inject so much money to change the usage or create value or something like this. So I would rather concentrate more on the big seven.
Great. And you can answer it if you like in terms of where the best kind of strategy for capital is, if you want, Felix, whatever's the best solution for you.
I think the market is bright, right? So therefore there are different opportunities like last mile logistic or urban logistic, as well as we strongly believe on hospitality. We have a dedicated operating hospitality team in field of hotels, but also selected office, urban living. We believe it's key that the assets are operated well and that an operational excellence approach is more important than ever. So my guess is that for the clients it's most important that the managers are close to the market, close to the assets, and that active management is absolutely key. So therefore I think the survivors or the key drivers in the market at the moment will be those with dedicated teams, close to the asset, close to the market, and close to sourcing.
Great, super, really interesting. And thanks very much for sharing your insights around the German market. I hope that was valuable to everybody here in the room and also to everybody watching on demand. I think some fascinating things that I'll take through to the other sessions that we've got around debt as well, but also around logistics. And we've got a lot of focus around cities and what's happening in terms of the institutional capital working there. So lots that we can take through into the next sessions.